Alright, welcome back to the fourth clip, fourth part of chapter 18. Here we are going to look at the three policies. We call this the flexible policy, compromise policy, and the restrictive policy. In short-term financial policy. Alright, what is flexible policy? So we start with the compromise policy first. Even though in the diagram here, compromise policy appears here, this line here, it should appear at the bottom here, this part here, alright, it should be here. That is compromise policy, it should be at this point. Alright, what is compromise policy? Compromise policy is when temporary assets are funded by short-term financing and permanent assets. Permanent assets here means permanent, current assets and fixed assets. Will be funded by long-term financing. Short-term financing will be short-term debt. Long-term financing will include long-term debt and equity. So this is called compromise policy. This is like a maturity hedging that we have seen in the previous clip. So this here means there would be both moderate risk and moderate return yield. Okay. Now, if you take flexible, if you move this line, this is supposed to be yellow line, if you move this up here, then it becomes flexible policy. At least some temporary assets are funded by long-term financing. So this portion here would be long-term financing. Some long-term financing would fund some temporary assets. Long-term financing will fund at least some temporary assets. More temporary assets funded by long-term financing, then it becomes more flexible. The further this line goes up, then it becomes more flexible. Okay, right. So the opposite is true. If this line, this yellow line here, if it moves down, then it becomes restrictive policy. So here at least some permanent assets are funded by short-term financing, because the long-term financing only funds until this much of assets. The others are funded by short-term financing. So more permanent assets funded by short-term financing, then it becomes more restrictive policy. So it's actually a question of degree. So a company can have a flexible policy, another company may have a more flexible policy. One company may have a restrictive policy, and another company may have a more restrictive policy. So the benchmark here will be the compromise policy. As long as temporary assets are funded by short-term financing and permanent assets are funded by long-term financing, then it's called compromise. That's very clear. But if at least some portion of temporary assets are funded by long-term financing, then it becomes flexible policy. And if at least some permanent assets are funded by short-term financing, then it becomes restrictive policy, or aggressive policy. Flexible here means conservative policy. So that's how you should interpret the various these three types of policies. Alright. So we can actually summarize this. We compare the three financing policies here. So you have temporary current assets and permanent current assets and fixed assets funded by what? So compromise policy is the benchmark, or we call this matching or hedging. Matching the what we call maturity. Maturity matching or maturity hedging. So this is also known as matching policy. So temporary current assets are funded by short-term financing, and permanent current assets and fixed assets are funded by long-term financing. That is called compromise policy. Now if it's flexible, then long-term financing not only funds this, but also funds some of your temporary current assets. And short-term financing only funds a small portion of temporary current assets. Then it's called flexible or conservative. Why is it flexible or conservative? It has a higher cost, but it has low risk. Okay, long-term financing has higher cost, yeah, but it has low risk of financing, yeah, but it also has high risk here, yeah. If these temporary current assets are rather small, yeah, if temporary current assets are rather small, it may have high risk, yeah. All right. Now, the restrictive policy or aggressive policy, on the other hand, when long-term financing only funds part of your permanent current assets and fixed assets, but some amount of short-term financing funds the permanent current assets and fixed assets, then it becomes aggressive. Short-term financing funds all of the temporary current assets, but also some permanent current assets and fixed assets, then it becomes aggressive policy. Why aggressive? Because it has low cost, high yield, but also high risk, very high risk. Because short-term financing, even though the interest rates are lower, it becomes due earlier, so you need to refinance or extend the financing or renew the financing when it becomes due. And if the company is unable to repay the loan and the interest, then it becomes risky, or it becomes problematic for the company. And the other risk is that the interest rates may fluctuate. Usually short-term interest rates are more volatile, so it can be low now, but it can go up suddenly later, therefore it is riskier. Alright, so there is always a trade-off. There are advantages and disadvantages, but how you interpret whether it's flexible or restrictive will be based on the benchmark, which is the compromise policy. Is that clear? Alright, let's move on to the next topic. Okay, now we come to topic number 3 in this chapter, which is the cash budget. Now, cash budget is a forecast of cash inflows and outflows over the next short-term planning period. So it's a primary tool in short-term financial planning. This determines the cash inflow and the outflow, and it helps determine when the firm should experience cash surplus and also deficits. When it needs to borrow, deficits must be covered by borrowing. Alright, so this can be determined by using the cash budget. So it allows the company to plan ahead and begin searching for financing before the money is actually needed, or the funds are actually needed. Alright, let's look at this example here. This is pet treats. It is a gourmet pet treat. Okay, receives income from sales. All income from sales. These are the sales estimates. So cash budget starts with sales estimates. Sales estimates. These are in dollars, millions of dollars. This is quarter 1, first quarter, second quarter, third quarter, and so on. And it also gives you the first quarter of next year. Alright. And you are given the accounts receivable, the beginning receivables, and you are also given the average collection period. Accounts payable, okay, you are told that purchases account for 50% of next quarter sales, and beginning payables are $125. Accounts payable period is 45 days. Then you're also given other expenses, wages and all that, 30% of sales. Interest and dividend payments are $50 every quarter, and then a major capital expenditure of $200 is expected in the second quarter. Alright, and you are told some more information here. Initial cash balance is $80, and the company maintains a minimum balance of $50. So initial cash balance is $80, but the company wants to maintain the cash balance to be not less than $50. Okay. So ACP is 30 days. So this implies that 2/3 of sales are collected in the quarter made, and the remaining 1/3 are collected in the following quarter. The quarter made here means the quarter in which the sales are made. Okay. Now, how do you interpret that? ACP is 30 days, means the average collection period for the firm is 30 days. It means that once you sell to your customer, you take about 30 days to collect from your customer. Now, in the cash budget, a quarter is made up of 3 months. Yeah. Now, if you sell, okay, throughout the quarter, okay, the first 30 days, yeah, the first 60 days sales will be collected within that quarter, yeah, because the sale that you make on the 60th day, yeah, from the beginning of the quarter will still be collected in that quarter. But let's say you make a sale on the 61st day, yeah. Now, if you make a sale on the 61st day, the collection will be made 30 days later, which is 91st day, yeah. Now, this 91st day will be in the next quarter, not in that same quarter. So, the last 30 days in that quarter, any sales made in the last 30 days will be collected in the next quarter. That is the meaning of this, yeah. Therefore, if the ACP is 30 days, this implies that 2/3 of sales will be collected in the same quarter, but 1/3, yeah, the last 30 days of that quarter is 1/3 of that 90 days, yeah. 30 days out of 90 days is 1/3. That will be collected in the next quarter. Okay, that is what it means here, yeah. Alright, so beginning receivables are 250, and this will be collected in the first quarter. The beginning receivables, okay, will reflect the 1/3, yeah, of the sales made in the previous quarter. That is why it becomes receivables, yeah, meaning you have sold but it has not been collected, and the value is $250. So this will be collected in the beginning, yeah, beginning quarter, okay, the first quarter. So the last 30 days sales of the quarter, i.e. 1/3 of the sales quarter sales, will be collected in the next quarter, which means 2/3 of the quarter sales will be collected in the same quarter. Yeah, that's the meaning of this. Okay, let's look at this in Excel. Yeah, we'll show this computation in Excel next. Alright, yeah, you can see here, this is the same example, yeah, given in Excel. You can see that this, yeah, we can click this is the beginning receivables, yeah, a portion of previous quarter sales collected in this quarter, yeah. So that is 250 million, you know that, yeah, this is 250 million. I've expanded to show the full amount, yeah. Now, collection for the current quarter, this will be 30 days, yeah, means 1/3 of quarter sales, okay, will be collected next quarter, which also means that 2/3 of the quarters, 60 out of 90 days sales will be collected in the same quarter, yeah. So here, how do you get $333,333.33, yeah. This is actually 60, okay, 90, yeah, minus 30, which is 60 over 90, that means 2/3 of this B2, yeah, 500 million, yeah, is collected in the first quarter. Okay, therefore this works out to be this, yeah. If $500 million of sales is made in the first quarter, okay, 2/3 of this, yeah, which works out to be 333 million, yeah, $333,333.33, yeah, will be collected in this quarter, and the remaining 1/3, yeah, will be here, collection in the next quarter. 30 out of 90, yeah, 1/3, okay, of this 500 million will be collected in the next quarter, yeah. So note this, if you add this and this, okay, it must be equal to the sales for the first quarter. This is not a cash flow, yeah, note this, yeah. This row is not a cash flow, it is the forecast of sale. The sale will be made, but it is not necessarily collected, yeah. So from this sale, only 2/3 will be collected this quarter. 1/3 will be collected in the next quarter. Is that okay? So this is the collection for the current quarter, okay, and this is the collection for the prior quarter. This prior quarter will be $250 million, which is the receivable now, yeah, which will be this receivable is a reflection of sales made in the previous quarter that will be collected in this quarter. Okay, so this will be collected in this quarter, and the sales made in this quarter, 2/3 will be collected in this quarter. Therefore, these two, when you add, will become the total collection for this quarter. Is that okay? Now, the next quarter will be the same. This will be